Fernando, what gives you the edge of sourcing off-market deals?
Yeah, this is my business partner Steven's whole thing. That's his specialty. The biggest thing is making sure that you're getting in front of the person and staying in front of them. Because self-storage is not like other asset classes that has a lot of distress. It's a cash cow investment. It produces very high cash flows. You're looking at stabilized assets that the expense ratio is only 30 to 40%. So 60% margin. It's a pretty good margin business, right? So usually these people, they don't sell because of an event. They sell because eventually it feels like the time, or maybe they need to retire or they want to retire. Maybe they're retiring for the second or third time, which we've had a lot of. So the key with these people is leading with contribution and staying in front of them. So it's not calling them and say, hey, do you want to sell your facility? It's, hey, I saw you're a fellow self-storage owner. I also own self-storage in the area. I would love to take you out for a beer. Just get to know each other.
Quick favor before we jump in. It always surprised me that a large percentage of people who listen to the show regularly haven't yet subscribed. If you're a commercial real estate operator, investor, or builder who values conversations like this around deals, capital, and technology, please take 2 seconds and hit subscribe. It's a simple, free way to support the show. My commitment to you is that my team and I will continue bringing you higher level operators, stronger conversations, and real execution level insights every single week. Thank you. I truly appreciate it. Welcome back to the AI Edge podcast. I'm your host, Luis Fernandez. Today's conversation is with someone who doesn't just invest in real estate. He approaches it with a level of discipline around risk, tax strategy, capital preservation, and most people never get to. Fernando Angelucci is the founder of Triple SE. And what they built is a nationwide self-storage investment platform focused on one core principle: protect the downside first and let the upside take care of itself. We're talking about over 50 facilities, hundreds of investors, and a model built around off-market deals, tax advantage structures, and operational discipline across multiple states. But what really stands out to me is how intentional the strategy is. It isn't chasing deals, it's building a system around capital, risk, and long-term value. Fernando, I've been looking forward to this one. Welcome to the show.
Thanks for having me.
When someone asks you, what do you do? How do you answer that?
I tell them that I run a private equity company. If I'm being serious, if I'm joking around, I say that I travel for a living.
Love it. Your journey's been described as wild. Take me back to the beginning. How did that all start?
Yeah. So when I was 16 years old, so I grew up in an immigrant household, very heavy focus on education, not only just high school, but college, and making sure that you get into top schools, and then eventually going to work for a Fortune 50 company. That was always the goal: retire with a pension. Then I read Rich Dad, Poor Dad when I was 16. It changed the way that I looked at how to make money, and then also time freedom, right? So I said, I want this. This seems like a great way to live life. So what I did at first was I wanted to start buying houses and flipping those houses. And I really didn't want to go to college, but my dad and my mom, they basically said, hey, go get a degree. You can get any type of degree you want as long as it's engineering, doctor, or lawyer. Pretty classic. And then if you want to go into being a business owner or a real estate investor, you can do that. If it doesn't work out, you can always fall back on your degree. So I did that. I ended up actually getting a job at a Fortune 50 company with a pension, surprisingly enough, but I only lasted about 13 months. So within 6 months, started doing real estate. By the 13th month, I quit. And then I went full time into flipping houses, doing contract assignments, which is colloquially known as wholesaling, and then buying rental properties with tenants. And so it went from smaller, single family homes all the way up to large apartment buildings. And then in 2016, I got burnt out. The three T's: tenants, toilets, trash. It was always a problem. I was buying rentals in a very tenant-friendly city, Chicago, and it made it very difficult to run. It was very stressful. And I was working so much for very little to show for it. And I said, this isn't the way to do it. So in 2016, I ended up starting to sell off all of our holdings, and said, I want to still stay in real estate because all the advantages that it gives, such as leverage and tax advantages, but I I just don't want tenants. I don't want anybody living in my investment. And so I broke it down basically into three different asset classes. The first was data centers. I don't have $1 billion in equity. So that was a no-go from the beginning. Then it was mobile home parks that I looked at. Mobile home parks, in theory, doesn't have tenants, but in practice, what ends up happening is people default on their lot rent, and then you end up, repossessing basically their mobile home, and then you end up being a landlord again because then you rent out that mobile home to people and try to sell it somehow. So I said that's not it. And then I found self storage. When I found self storage, the more I learned about it, the more I loved it. The laws are in the favor of the owner. Very easy to operate. It's not viewed as a basic human right, so the government doesn't get involved. Like we saw during the pandemic, when tenants couldn't pay their rent, the government said, "That's all right. We won't allow any of your landlords to evict you." But at the same time, these landlords lost their source of income, but they weren't granted any right to stop paying their mortgage or stop paying property taxes. Really loved the niche, and now that I've been in it for almost a decade, the more I learn about it, the more I see that it's a great way to build wealth. It's a great way not only to build wealth, but then to actually have time freedom. These facilities that we buy and build, you can operate them with very little staff to the point where you don't ever have to step foot inside of these businesses. So that's a true business, right? It's not building a job for yourself, which is what most people think of, or most people do when they think of being, building a business. These are true businesses where they operate without me having to be there on a daily basis. So then very quickly, I learned that this is what I wanted to do. I started buying my first couple with the proceeds of the apartment buildings that we sold. And then very quickly, I ran out of money. So once I ran out of money, I realized I need to also run a capital raising business and a marketing business, because the marketing business, what finds the deals and also finds the investors. Then you have the real estate business, which is the operations business, making sure that you're doing the value add and providing returns for your investors. And then you have the capital raising side, which is, the investor relations and the compliance and tax returns and K1s and all that stuff. So once we started bringing in outside capital, then it kind of took off. How most people do, we first started with our own money. Then we started using our family's money, then friends' money, then friends of friends and friends of family. And eventually we built up a large enough track record that we could start raising capital from people that don't even know who we are. And then we needed to start reaching out to those people and showing our expertise to them, educate the market to dominate the market. So doing things like this, going onto a podcast and talking about what we do to attract investors. So now we have a little over 1,000 investors. They've been going along with me. Some of my oldest investors are still with me over a decade, and it's been fantastic. It's allowed me to live the life that I have always dreamed about living, help people that I wanted to help, and participate in these local communities where our facilities are located.
Incredible. At what point did you realize that weren't just investing, but you were building a model?
Yeah. So I love reading. So I've read tons of books. I think my Audible on my phone right now has probably over 400 books. And I always read things about business building and sales and mindset, things like that. And one of the books that I always go back to is Think and Grow Rich by Napoleon Hill. And he talks about the power of masterminds, getting together with business owners that do what you do or similar things to what you do, and then being very transparent and open about what your problems are, sharing those things and looking for solutions. So very early on, I was kind of doing the same thing that I'm saying right now is what you shouldn't do, which is I was creating a job for myself. I wasn't creating a business. And what we've learned from these masterminds is to escape the working in the business to be able to work on the business, you need to create processes and procedures. You need to be able to first eliminate things that are unnecessary, then automate things that are unable to be eliminated. And then anything that's not able to be automated, you delegate to someone else. If let's say if I'm an owner, I make $200 an hour, it doesn't make sense for me to do tasks that I can hire someone to do for 18 or 20 bucks an hour, right? So it's arbitrage of time. And that's when we really started to build a business as opposed to, a self-employed job, if you will.
Incredible. Let's talk a little bit about your business, Triple SE. So Triple SE today, how did you actually describe that and on what you actually built?
Yeah. So, first and foremost, we're a private equity company that focuses only on self-storage. And we do that using basically three strategies. The first is to buy mom and pop facilities and roll them up into portfolios. We do the value add, we stabilize those assets, basically turning them into armchair investments. And then we put them into a bundle of 10 to 15 properties and sell them off onto larger buyers that are looking to outlay large amounts of capital. So that is where we very first started, buying smaller facilities that were a little bit older, increasing operational efficiency, leveraging technology, increasing revenue, dropping expenses, increasing net operating income, and then also increasing the grade of the facility by doing CapEx, capital expenditures to renovate and in some cases expand the facilities. What we noticed very quickly is that if we can put a lot of these, $2 to $5 million facilities together and sell them as a package that is 30 million or $50 million, all of a sudden we started unlocking a set of buyers that had a much larger pocketbook, if you will, and were willing to buy things at lower returns than the smaller buyers were willing to do. So what we notice is that by putting these properties together into regional portfolios, we're able to get anywhere between 50 basis point to 200 basis point increase in valuation on those cash flows. So that's the first part. There's the issue with buying these smaller facilities that are typically 25 to 50,000 square feet. That's a lot of roofs. It's a lot of heaters, a lot of AC, but each one of those locations needs its own staff. So then our answer to that was to start building Class A ground up facilities. So these are facilities that are anywhere between 85,000 square feet to 115,000 square feet. So they're very large. One of these facilities alone sells for anywhere between 18 to 25 million a piece. So now we're able to simplify by building larger, by basically putting a zero onto everything that we're doing. And what we found out is when we're doing these larger projects, it's easier to raise capital. It's easier to acquire debt for these larger properties. It's easier to build out a team to do the management for that facility just because the cash flows are much higher. So it's just easier to manage, easier to operate. And so, those we usually sell one off to either the publicly traded REITs or the privately held REITs. And then we have a third smaller strategy, which is it came about due to the pandemic. You had a lot of big box retail stores that were going dormant because nobody could go out and shop. So everything went online. And when it went online, a lot of these stores like Sears buildings, Kmart's, Walmart's, Circuit Cities, they went out of business and they left behind these great structures that were in the middle of, majorly trafficked thoroughfares surrounded by dense residential, people with high median incomes that had the disposable income to spend. These are all things that we want in self-storage as well. So instead of having to try to find some location to build new, we can buy a shell that's already in place. And by doing so, convert it into self-storage and save, anywhere between 25 to 30% of our construction budget, but then also shorten the time of shovels in the ground to an operating cash flow. So that's all great things for the investors. And then, to source all of these opportunities, we had to create a marketing company. And that marketing company basically markets to the entire lower 48. There's roughly, let's say, 60,000 self-storage facilities in the United States. So there's not a lot, right? There's a lot of people competing for the same type of buildings. So you want to be able to get in front of everyone and stay in front of them on a 3 or 6 month basis so that once they are ready to sell, they come to you first. And the nice thing about doing that is now you have all these deals to choose from, which allows you to cherry pick the best ones for your investors. And then the ones that are still pretty good, but for whatever reason, they didn't check all the boxes on our buy box criteria, we are able to put those under contract, do all the due diligence, put together a package, and then sell those purchase contracts or the right to buy those assets to someone else and walk away with a fee without ever having to go on title. So without having to take the risk of actually owning that asset. And so that's what we call our wholesale strategy. We wholesale facilities to other operators, and that allows us to re-up our marketing budget. And it also allows us to monetize everything that's coming in or almost everything that's coming in on a lead basis. So that has helped quite a bit.
Incredible. You emphasize tax advantages and downside protection. Why start there instead of returns?
Yeah. So what we've found is that the majority of our investors already make a lot of money and they need ways to keep the money that they're making. So from the get-go, it's how do we structure these investments in a way that is tax advantaged so that not only does it offset the taxable gain from the investment itself, but potentially can offset gain from other investments that they make. So one of the things that we utilize is cost segregation studies. What that does is it goes through the entire facility. It breaks it down into its component pieces. So instead of saying, hey, this entire building, we're going to depreciate it over a 37 or 39 year schedule. Well, they say, well, this desk isn't going to last almost 40 years. The carpet isn't going to last 40 years. That may be 5 years. The doors may be 15 years, whatever. And they break it all down. And then because of bonus depreciation that is allowed to be taken, anything under a 20-year schedule, you can take all of that depreciation in year one. So what does that mean for our investments? Well, coupled with leverage, if we can get a very high leverage deal through either seller finance or some structuring of debt and mezz debt, the equity is the only piece that gets to experience that bonus depreciation. Obviously, the lenders don't get to experience that. So let's say, for example, you have a facility where it has $1 million in bonus depreciation, and it may be call it a, $8 million facility. But if you only have to bring in $1 million of equity to close on that, because you either use seller finance or one of these complex structuring, creative structures, then all of a sudden, every dollar that an investor puts into this deal, they get $1 back in losses in the first year. So if they made gains somewhere else, so what ends up happening? We have a lot of investors that now know that we do these tax advantage strategies that around Q4, they start planning for what their tax bill is going to be at the end of the year. And they say, oh, shoot, I need to offset $300,000 of taxable gain, or else that's going to have to come out of my pocket. Fernando, you got any good investments that can pass through some great losses? I say, sure, all of our deals are structured this way. So then they come in and they invest, $300,000 or $400,000 to offset all of their taxes for that year, and allows them to kind of push that can down the road and find more strategies to eliminate it. So it's kind of I always call it a poor man's 1031, but I think that's a derogatory way to explain it because it's much better than a 1031. 31, you have very fixed timelines, and if the buyer or the seller knows about that timeline, then it can also cause an issue for you, because then they know that you are time challenged, which then they can start negotiating against you, raising the price, lowering the price depending on what side of the table you are on, et cetera. So that's not the case with bonus depreciation. It's just you have to do the two transactions within the same tax year. So if you sell something on January 1st, you have a massive tax liability. You have until December 31st to offset that tax liability using bonus depreciation. So that's one of the tax strategies that we employ. There's other ones. We put solar panels on our facilities that allows us to offset, solar credits that we can apply back to the investors. We can sell those credits off if you don't need to use those. There's Section 179, which allows us to take 100% of the depreciation on equipment that we use. So you can do that for portable units that you put on self-storage facilities, what have you. Now, the downside mitigation piece, I think, is the most important piece, because before you can even think about gains, most people are concerned that they're just not going to lose their capital. That's number one. So how do you structure deals in ways that reduces the risk to the investors and allows them to capture upside gain once it comes? So that comes down to a whole slew of things. You can have making sure that you're doing underwriting appropriately. You're bringing in third party underwriters, so paying somebody as a third party feasibility consultant to show the feasibility of your project. That feasibility report you can give to your investors, you can give it to your lenders. Your lenders are obviously, they're putting a bunch of money into the deal. They're putting more money than you usually are. So they're going to be underwriting themselves to make sure that you're not losing. So making sure that you're working with all your partners. Our, property management firms that we use to manage our assets, they also are going to underwrite it for us and tell us what they think, how it's going to perform, give us a pro forma over 5 years. So we do that with multiple firms on each given asset to see what everybody is thinking. So that's number one. And then number two is just how do you structure the deal in a way that you can also limit downside risk? So for example, you can get very creative with structures with sellers where you say, hey, Mr. Seller, look at all this interest that I'm going to be paying to the bank. Would you like to earn some of this interest? Say, yeah, I would. And then all of a sudden now you can structure assets and deals in a way where you are getting below market rates with above market leverage. So if I go to a typical bank for a construction project, I have to put 35% down and I'm going to be paying 7 to 8% in interest, plus a massive, all these loan covenants and all this other stuff that they can trigger default if something doesn't go right or if I don't get a report to them in time. Whereas if I go to a seller and say, hey, let's just keep it simple. And then, for example, we closed on a deal on New Year's Eve where it was 5% down instead of 35% down. And instead of us paying 8%, we were paying 5%. And that was interest only for like 7 or 8 years. So much lower risk because of the amount of payments that we have to sustain on a monthly basis. And then, sellers don't have bank attorneys that they pay $800 an hour for typically. So the loan docs are usually much more lenient, and they're usually much more willing to work with us if something doesn't go according to plan. So that's just one of many ways that we can structure these things. Another way is, through our syndication structure, where we have general partners, which is us, the operating partner, and then you have limited partners. The limited partners, they're called limited because their liability is limited. If something goes wrong, the bank isn't going after them to get their house or their car. They're coming after me, the operating partner. So I'm mitigating risk for the limited partners, and I'm taking on that risk. And then the way that the payment structures work, right? So the limited partners are always the first ones that get paid out before I see anything. And that's how you typically will set up syndication structures, where the general partners, for getting the ability to use other people's capital, they have to be the last in line to collect any profits. And that usually will help align incentives with the limited partner. So there's a ton of ways that you can not only structures to be tax advantaged, but also to mitigate downside risk.
Amazing. Let's go into how you operate. Now we get into the machine, right? So you've
Yeah.
scaled across multiple states, multiple facilities, and large investor base. Walk me through this. When a deal comes in, what actually happens step by step, sourcing to closing?
Yeah. So once it comes in, it goes through a series of internal underwriting steps. There's 3 levels of underwriting. Once it clears those hurdles, we'll put it under contract, and then we will also bring in a third-party feasibility consultant for the 4th level. The 4th level underwriting is third-party underwriting. So not only does a feasibility consultant underwrite it, but then all of the potential property managers that we're going to hire to manage that facility, they will also submit their underwriting and their pro formas. And then the bank, their credit department, will also do an underwriting pro forma included with an appraisal. So 4 levels of underwriting to make sure that, first of all, we're buying right. Then once we actually say close, or we're about to close on the facility, once I have a commitment letter in hand from the bank saying that we will honor these terms, then I go and start raising capital. And to raise capital, I put everything that I gave to the bank into a file for my investors for them to review, including the feasibility study, which is extremely important. And then I show them the deal modeled out over a 3 or a 5-year period, depending on what the hold period is supposed to be. How do those investors get access to these deals? Well, they hear me on podcasts like yours, and maybe they go to our website. And when they sign up to be an investor, they have a quick interview with me. Once they're done with that interview, then their account is liberated, if you will, and they'll start receiving emails every time we have an investment available. Let's say they look at everything, they like what they see, they want to invest. Well, then they go into our investor portal, which is our compliance side. So that's where it houses all the financial documents, the K-1s, tax returns, everything. And in there, it goes through a very simple process that shows, we need your W-9. We need to make sure you're an accredited investor. Here's the, sign the subscription agreement, sign the joinder to the operating agreement. Goes through it's all DocuSign based. So it's our electronic signature, I should say. And it's very quickly. And then at the end, it gives them the option to either connect their account through a third party like Stripe or Plaid, that allows them to, ACH their money into the account, and vice versa allows us to ACH distributions back to them. Or if they don't feel comfortable using a third party, then they can just get the wire information and wire all that in. So once we have all the equity in place, then we go to the bank, say we're ready to close, go to the seller, say we're ready to close. We manage everything with the title company, and then we close. Starting on day 1, typically what we do is we get rid of all of the, the seller's old staff. If they decided that they wanted to stay. Typically, I'm not buying stabilized assets, right? So if you weren't able to get it to where it needs to be before I bought it, you're probably not going to be able to get it to where it needs to be after I bought it. And then we start going down the checklist of value add. First, we do the non-CapEx value add, and then we do the CapEx value add. So first, are we pricing our units at the same price or near the same price of all the competitors? If we're way below them, then we need to raise those. Usually the sellers don't even know what their competitors are charging. So we have competitor analysis. We go in, we look at anyone that's delinquent or that owes fees for paying late, was waived for whatever reason by the old seller, just not collected. We'll go in and capture all that. And then anyone that's delinquent that isn't able to get on a payment plan to come current, we start the auction process, going through all the legal steps we have to. It usually takes anywhere between 45 to 60, 65 days. After that, then we look at all the expenses. Where can we, I've bought facilities where they had a $500 a month cable TV package. Why? The People are there to work. They shouldn't be watching TV on the job, right? So that's out immediately. And then things that come with economies of scale, so like insurance, property management softwares, technology that helps with the process. I know this is an AI podcast, so I'll talk a little bit about some of the AI things that we use. Not only is there AI used in our capital raising side, from the marketing all the way to the document matching and updates, but then also from the operations standpoint, we have softwares that will scrub the web and take all the data that it sees from existing tenants, and then it'll rate them on a level from 0 to 10 to see if they're willing to absorb a rent increase. So let's use some hypotheticals here. Let's say you're somebody that pays in cash every month, you're late every month, and you have some open social media channels online that you're always posting about having medical bills or you're having problems paying. Most likely you're going to get scored towards the bottom, 0, 1, maybe 2. You're probably not going to get a rent increase. However, on the other side, if you're somebody that pays every month on time via auto pay with the Amex Platinum card, and you have some open social media accounts that shows you traveling first class and going to Dubai and going to, Bali, these types of things, you're probably going to be scored closer to 8, 9, or 10. And then the system will say, okay, now that we've scored everybody, here's what we think they will absorb. And maybe it's towards the bottom, it's no increases. Towards the middle, it's 5 to 8% increase in rent. And towards the top, it could be as high as a 30% increase in rent. So that's one of the things that it does. Another thing that it'll also do is it'll create a good, better, best system. So let's say you want a 10 by 10. Well, all those 10 by 10s aren't the same. That's like saying that I want a seat on the plane. Every seat should be the same price. That's not the case, right? The cheapest seats are in the back next to the bathroom. Then you can upgrade to get premium economy, or you can upgrade to be in first class or business class. And that's the same thing that we're doing now with self-storage. So if you want a unit that's on the 3rd floor, the farthest unit away from the elevator, that's $100. But if you want that same 10 by 10 unit next to the elevator, that's 110. If you want that same 10 by 10 unit on the ground floor right by the front door, that's 130. What we found is that, 30 to 40% of the time, someone will choose an upgraded option, either a better or a best option over the good option. So that's great. And then it also, it does dynamic pricing for us, just like the airline industry. If you're trying to fly to New York City during Christmas or Thanksgiving, you're going to be paying a pretty penny for that. But if you're not, if you want to fly off season, and you're willing to book 6 months in advance, you'll get a cheaper price. Same thing with self-storage. If all of a sudden, let's say we have a facility near a university, and the university is getting out of school, and the students need to store their stuff for 3 months, and they all are looking at the same time, well, guess what? Rates are going to go up substantially, because we're going to start seeing these increases in Google searches looking for storage in that specific town. And so the system will identify that and then start raising rents. And it'll also see what the competitors are doing. If the competitors are raising rents, most likely we're also going to be raising rents, because they are now setting the new floor. So that's all the kind of the non-CapEx stuff that we'll do. And then that's when we get into the CapEx afterwards. So we're talking about if it's a gravel facility, we'll pave it. We'll put keypad entry and exit so we can track tenants as they move in and out of the facility or through the facility if there's multiple doors that they have to get through. We'll do, painting, replacing doors and springs, replacing the roof, even to the point where we'll expand the facility if there's additional land that comes with the facility and there's additional demand that we can't handle with our existing supply. We'll expand those facilities as well. And then once the facility is stabilized, we'll usually hold it for 6 to 12 months to show that trailing stabilized income, and then we'll put it up for sale, either in a portfolio or as an individual asset, depending on the size of that asset.
Incredible. You talked about 3 core pillars: deal flow, capital, and operations. What's the hardest one to consistently get right?
Yeah, it's definitely capital, because capital is a way, first of all, when you're raising capital, you have to kind of go in baby steps. No one's going to write you a $5 million check if you have no track record, right? So who are the people that you can start with to give you a track record? These are the people that know, like, and trust you. So I always tell people, if you're going to start to raise capital, look at your Rolodex, download your contact list, and put what they are to you next to their name. Is it a friend? Is it a family? Is it a friend of a friend? Is it friends of family? So first you start with kind of your inner circle, which is you, your friends, and your family. They're investing with you because they know, like, and trust you, not because they're looking at the deal that you're investing in. Eventually you build up a track record with these people, and they start telling their friends. So now you're investing with friends of friends and friends of family. And eventually once those people are investing with you because not they don't know, like, and trust you. They know, like, and trust someone that knows, likes, and trusts you. Then after that, that's when you start breaking to the next step, which is that retail investor. The retail investor doesn't know who you are. So first of all, how do they find you? Once they find you, what is going to convince them to call you or to do outreach? So you have to educate them on why you know what you're doing and how you do it. And here's my track record to show that I know what I'm doing. And then eventually, once you start building up a large track record with the retail investors, these are people that don't know who you are. Eventually, they'll eventually know who you are and like you and trust you. And then you can start going to kind of the sub-institutional or institutional investors. These are going to be your, family offices, wealth management, registered investment advisors, and then even up to the point of, pension funds and endowment funds, retirement funds, things like that. So it's raising capital is definitely the hardest part because you have to first find them. There's no, here I'm going to the capital store and go get some capital. That doesn't work that way, right? So you have to make sure they can reach you, which means you have to put out a lot of content, a ton of content. And then you have to be expertise of that content. And then once you get them, you have to keep them happy forever. Because an investor that you do good by and you get them a great return, they may tell 1 to 3 people. If you mess up and they don't get the return they're expecting, they're going to tell 100 people of why. It's the same thing with reviews online. They're always skewed to the negative because if something goes according to plan, everyone says, great, that's what was supposed to happen. So they may leave you a positive review. They may not. Most likely will not. But if something doesn't go according to plan, they're going to review bomb you on every platform they can find your name on to warn everybody else. So now you have to keep those investors happy. So that's just the return side. But then there's also the compliance side. Making sure that you're getting them their tax returns and their K1s in proper timing. This is a piece that a lot of syndicators struggle with. They tell all their investors to file extensions and to file their tax returns in October. But the thing about a lot of people that file tax returns is they want that refund check and they don't want to wait till October to get it. So they're going to be hounding you to get them their K1s in time so that their CPAs or them personally, if they're filing their own taxes, can file in time to get their refund check. And then the second thing is, are you staying in front of them and telling them what's going on with their money? I know a lot of people that they have told me horror stories of they gave an investor cash and then they never heard from them again. And they'd have to constantly be hounding them to get updates on what's going on. Whereas our system is we have a set schedule. Every quarter, all the financials come out, photos, updates of what's going on, not only from the operations standpoint, construction, K1s, everything. And it's all housed in one compliant portal. So, the thing about K1s, it has sensitive data, it has social security numbers, EIN numbers. You shouldn't be emailing these things to people. You shouldn't even be mailing these things to people. There needs to be some secure way for them to get that so that you are, being a good steward of their data. And so these are all pieces that flow into the investor relations and the capital raising side of the business that most people that start raising capital just completely forget about. And I always tell people, if you're not ready to speak with every one of your investors, at least on a monthly basis, if not a quarterly basis, maybe raising capital from outside investors is not for you.
You syndicating or do you have a fund?
We have both. Yeah. So up until recently, everything we did was single asset syndication. So we had one deal, would raise money for that one deal. And then over time, we had such a good track record that people started saying, hey, I'd like to invest across multiple deals. I'd like to spread my, whatever it is, $100,000 check, $200,000 check across multiple deals. I said, okay, then we'll do it. So after opening and closing 39 full cycle syndications, we've averaged about 57% internal rate of return. We decided to launch our first fund. So most of our syndications are typically $3 million up to, I think the largest one is $5 million that we've done. The first fund, we said, hey, let's go small in the first fund and let's see how it goes. Let's see if people actually do want this like they say they do. So we launched our first diversified self-storage fund. It's a GP fund in December, and it's a $25 million fund. We're raising capital very quickly, which is great. So it seems like people are liking the model. And then it also allows us to raise capital from larger check writers. There are family offices out there that say, hey, our minimum is $10 million. We're not going to write a check for less than that. Maybe on the first deal, we'll go down to $5 million. But if all your syndications are $3 million, they're already priced out. And a lot of these guys say, hey, we'll write a $5 million check, but we don't want to be 100% owner of the LP position. We want to be alongside other LP investors. So then you need to be even larger syndication. So the fund has done a lot of great things for us. It allows people to diversify with a smaller check. So as opposed to putting, our minimums typically are 50 to 100,000 per deal. Now they could put 100,000 into the GP fund. That GP fund will do 10 to 15 deals. So now they're only allocating roughly 10 grand to each deal. 7 grand, 8 to 10 grand. So now you're diversifying not only from a deal standpoint, but even geography standpoint as well. So it's been great.
Amazing. So I've had the previous podcast guest on who is interested in raising institutional capital. What suggestion or what advice do you have for somebody wanting to go that route?
Yeah. So I personally don't like institutional capital. So if you were asking me, I would say don't raise money from institutional partners. It's better for you to build up a network of retail investors. Now there's trade-offs, obviously, right? The nice thing about working with an institutional partner is it's one check and they take
That's
out,
what we
they'll
wanted.
write you a $40 million check, $50 million check.
That's what he
But guess
wanted. He
what?
wanted bigger checks.
Yeah. But now guess what? Now they have a lot more power over you because they're the single check writer. They know you need that cash. And then they start offering you deals or profit splits that aren't necessarily very conducive to you as the person creating the value. Right. So what I usually tell people to do is, like, if you absolutely want to raise money from institutional capital, make sure you have some of your own money to put alongside theirs, so that they're not all of the capital in the deal. Where I've seen institutional capital really make sense is when it's 50-50 split. So if you need to raise $40 million, the institutional partner puts in 20, you put in 20 of your own. And then the terms start to become very fair, because you have not only do you have the same amount of cash at risk that they do, but you're also doing all the work. So it's very hard for them to say, well, we want 95% of the profit and you get 5% as the first hurdle. But you say, no, that's not going to work here, right? Whereas if you were to start kind of on the lower levels, with these $100,000 check writers, or, maybe $1 million check writers, so retail investors, accredited investors, all the way up to, let's say, small family offices, $50 to $200 million family offices, then it's a lot more fair to you as the person doing all the work, especially if you're investing alongside the capital, which I think is mandatory. We put 10 to 20% of the capital stack in of our own cash. Then you end up having a lot more control. And why do I say this is great? Because I've looked at this based on offers from institutional, non-institutional capitals. Working with my investor base right now, we have a little over 1,000 investors right now. I only need to do one deal to make the same amount of profit personally that I would need to do 4 to 5 deals taking institutional capital, because the profit splits may be very conducive to them and not so much to you, versus working with a retail or small family office that understands the value that you're providing. So if you're going to ask me personally over a couple beers, I'd say don't do it and build out your own retail investor, channel. But then it comes with its own problems, right? So now instead of, making one phone call, now you have 1,000 phone calls. And instead of filing one K1, you have 1,000 K1s. And then the problem with working with retail investors is they get tapped out pretty quick. You're talking about people that on the bottom end are $1 million net worth. That may seem like a lot of people that don't have a lot of money, but $1 million net worth that's not a lot of liquid cash for you to put across multiple deals. So all of a sudden you do one deal, maybe 2 deals with this person, and then they're tapped out completely until those projects that they're invested in with you pay out. And that could be 3 to 5 years from now. So now they're no longer have any more cash to give you until, you sell these assets in 3 to 5 years. Whereas institutional capital, they're constantly raising money. They have a ton of money that they're sitting on. If you want to do 100, 200, 300 million with them, they can easily help you with that. Especially if you're on the larger institutional side, which are the, retirement funds, endowments, the pension funds. These guys, not only do they have a lot of money, but then every paycheck, there's more money going into those accounts because they're retirement vehicles for all the people that invest into them, right? So they're constantly have new flow of capital coming out. So it's this trade-offs. I'm not saying that I would never, ever do a deal with institutional capital. It's just the terms have to make sense. And I'd only take their capital if I can match them dollar for dollar.
Fernando, what gives you the edge of sourcing off-market deals?
Yeah, this is my business partner Steven's whole thing. That's his specialty. The biggest thing is making sure that you're getting in front of the person and staying in front of them. Because self-storage is not like other asset classes that has a lot of distress. It's a cash cow investment. It produces very high cash flows. You're looking at stabilized assets that the expense ratio is only 30 to 40%. So 60% margin. It's a pretty good margin business, right? So usually these people, they don't sell because of an event. They sell because eventually it feels like the time, or maybe they need to retire or they want to retire. Maybe they're retiring for the second or third time, which we've had a lot of. So the key with these people is leading with contribution and staying in front of them. So it's not calling them and say, hey, do you want to sell your facility? It's, hey, I saw you're a fellow self-storage owner. I also own self-storage in the area. I would love to take you out for a beer. Just get to know each other. Or if you're going to one of the conferences, or if you're going to the state SSA or the national SSA or the ISS World Expo, let me buy a lunch or let me buy a beer, whatever it is, and just get to know them and then see how you can help them. What are your biggest struggles right now in your business? Property management? Let me connect you with some property management people. Accounting? Let me account. Is it bookkeeping or doing taxes? Let me connect you to my people. So by leading by contribution and helping them grow their business eventually, and then staying in front of them, call, letter, email once every 3 months, every 6 months. The best deals we've ever did were the ones that we've been talking with the seller for 5 years. And they eventually decided that I was ready. Even sellers that said, I will never sell. I remember one of the best deals I did in Tennessee. The seller reached out after I was talking to him for years. And they said, my wife said it's time for us to sell. So I'm going to have to sell. I would love you guys to have a first shot at it before I bring it to a real estate broker. I said, great. I really appreciate that. And because I've been able to help them and hearing all the problems they're having with the facility, I already know how to value it in a way that it's a win-win for everybody. So the key is to stay in front of them and to add as much value as you can and not approach it as a sales call, but more of just a relationship, ongoing relationship.
Most operators think that they have a deal flow problem or a capital problem, but at scale, usually something deeper. In your business, Fernando, what's the constraint that usually limits growth right now?
Yeah. So the thing with businesses that grow quickly is things break all the time. And I'm trying to remember, there was a book, I'm trying to remember who wrote it, but they had this theory that your business will break in multiples of 3 and 10. So every time you triple in size or every time you 10x in size, all the systems that you were using break. So the interesting thing about that is, if you had unlimited money, you can just start using the systems that would be needed for a 10,000 person organization. But the problem is those systems are extremely expensive. So you can't do that. So you have to be building and fixing things as you're growing, because you can't just skip from step 1 to step 8, because step 8 costs way too much money for someone at step 1 to pay for. So the key is, how do you anticipate when things are going to break with enough anticipation, but without being too far into the future, where you have the cash flows and free cash to pay for the next level of services that you need in that business, and not waste money or not waste resources. There's no use in having a CRM that's built for 100,000 contacts when you only have 10. Right. So you're wasting that resource and you're wasting money on that resource. So I think the biggest challenge that I've always had, and this is one of the things that I've loved being a part of masterminds for, is anticipating when a system is no longer going to work for us, when we need to bring in new systems or new employees or new vendors, new service providers. I think this is one of the things that it's hard to do when all you're focused on is being in the business, aka you have a job for yourself, a self-employed job and not a business. And something that starts to get a lot more clear when you're able to put processes and procedures in place, that it removes you from working in the business and now you're working on the business from top down and seeing how to move forward, how to project into the, 1 year into the future, 3 years, 10 years into the future, so that you're ready for when these things break and you need to find a new solution.
So when things start moving really fast, multiple deals, capital's coming in, operations are expanding, where do you feel the friction the most?
Yeah. So I think number one is going to be, every time you add in one location, it causes friction in another location. It just shifts the bottleneck, right? So let's say you're having issues of not having enough deal flow. You end up hiring additional acquisition team members. But then what happens very quickly is those acquisition team members, if they're good, start getting deal flow. So now you have to be able to close on that deal flow. So now you need to hire somebody that will help with the capital raising, help with the debt acquisition. And then once you do that, now you have a bunch of properties that you need to manage. So now the bottleneck moves from capital raising and debt sourcing into operations. So then you need to be able to bring in professional operations. So what we found is that there's kind of two ways to build this. You can build it all internally or you can leverage externally. And it really just depends on whether you are comfortable having very high fixed costs or if you're willing to pay a little bit extra premium to move those fixed costs into variable costs. So here's an example. The first 10 to 15 facilities that we had, we self-managed those. We built out a property management team inside of our business and very quickly realized that property manager is a loss leader unless you're doing it at scale. And I think in my business, you need at least 50 facilities, if not 100 facilities in a regional location for the property management to actually be very profitable. So then what you can do instead of having that fixed cost in-house, you can fire all your in-house people and then you can bring in third-party contractors where this is what we do now. We hire professional property management firms because instead of being okay at everything, I'd rather be amazing at what I do and then hire someone that only specializes in that one service I need. So now I'm hiring a property management firm that all they do is specialize in third-party management of self-storage facilities. And then you end up getting much better results while also keeping your fixed costs low. Yes, you're paying a slight premium on variable cost, but if something happens like a pandemic or a global depression, I can very quickly turn off that spigot and say, we're done with this contract. There's no employment law issues. There's nothing. They're a service provider. That's it. They're a vendor, right? So you can do that on all sides. You know, if you're having trouble getting debt, you can hire a debt broker. If you're having trouble raising equity, you can hire a broker dealer, an equity raiser for you. You know, make sure to do it legally. The SEC has very strict laws around this. So just a caveat, talk to an attorney first. So, what we specialize in is A, deal flow, and B, capital raising. That is what we're very good at. And very far third, I would say, is debt structuring on the seller finance side. Mm-hmm. But these loan brokers that we use are much better than we are at finding and negotiating with individual banks when the seller is unwilling to carry the financing. And then same thing with the property management. We no longer do property management in-house, except for some very niche cases. And we'd rather just hire one of the top, 10, 20 operators in the country to operate those facilities for us. So I think that's the key is knowing where your bottlenecks are coming and whether you want to build basically a new company in-house or if you want to outsource that for a slight premium for being able to move it from fixed cost to variable.
Amazing. Fernando, let's flip the switch a little bit, go AI. We are the AI Edge podcast. So with everything that you built, where do you actually see AI or automation creating real leverage in your business?
Yeah, there's a ton of locations in our business that it's creating edge. So self-storage is historically a laggard when it comes to adoption of technology. Recently, that has changed as private equity companies have been coming in and buying up the service providers in our industry, which has been allowing to inject a bunch of cash into R&D to help the people that are using their services. So we already talked about that system that we use for basically dynamic pricing and good, better, best, all that type of stuff. But basically across our entire technology stack, AI has been making our business much more efficient. So from creating copy, something that we used to have to pay somebody for or spend the time internally to do, to syndication of that copy out across social media and across the internet, even to the point where now the responses, you can create chatbots that they'll respond to the people responding to your post to create more engagement, all the way down to how our, file management works and how that works with our emails and how everything's integrated to our CRM. And then even on the capital raising side, document matching, K1s, even helping with bookkeeping, taking kind of the lower level tasks that someone used to be paid to do. And now you can pay somebody just to double check what that technology is producing. And if it catches any errors, it can train it to change that and then also manually change it themselves. So, I mean, it has been changing even down to podcasts, for example. You when you're interviewing somebody, you can have an AI agent listening to the conversation and automatically start prompting you with questions to respond to those to those answers that your guest is giving, and then even using it to edit all of the footage, crop the footage, add in captioning, syndicate that across all of the social media channels. I mean, opportunities are endless. It is wild how it's affecting not only our industry, but just all industries in general.
Incredible. If you could remove one bottleneck overnight using systems, what would it be?
Is a great question. If money was no issue, I would say it would be the capital raising side. The part of capital raising is tough because it's a very relationship based business. So, when somebody calls me, they want to talk to me. They don't want to talk to a AI clone of me, at least not yet. The adoption of that is, we're still in its infancy. I mean, I've already seen it in a lot of my, when I call my bank or I call some of these service providers that I use, it'll bring me to an AI chatbot or voice bot off the bat. And, I'll be honest with you, I have always been somewhat of a laggard as well. And I do get somewhat frustrated. I start clicking zero or say, talk to an operator, talk to a human being, whatever it is. But eventually the adoption will take in, just like everything else. I mean, I remember when Excel came out, accountants thought that their jobs were over. And what ends up happening is the accountants just end up using Excel. It's a tool. It's not going to replace you. And I think the same thing is true with AI. It's not going to replace a lot of people, but it's going to become a tool that those people use to make their output per hour increase.
What are most investors or operators misunderstanding about AI right now?
Yeah. In our business, we kind of have two main things. The first is we have the customer side. So people actually wanting to rent self-storage units. And we've already seen a revolution in our business of moving from manned facilities to unmanned facilities. So where now people, instead of walking in to an office and being greeted by a live person, they walk in and there's QR codes, or they walk in and there's a motion sensor that triggers a live video call with someone at a call center. So now someone doesn't need to physically be at one facility, and that person's time can be split across multiple facilities. But I can very easily see how quickly that person on that video screen is not a real person. I mean, I've already seen some wild videos come out that it fooled me at first, right? That it was a real person talking, et cetera. Obviously, it's pre-recorded, so it's not interactive, but eventually it'll get to the point with how things are moving at a geometric level, exponentially increasing in power. Eventually, what people are watching right now, you and me talking, eventually you and me will just be AI clones of ourselves talking to AI clones of another person and producing this podcast content, right?
Hanging out at the beach, having a beer.
Exactly.
I love it. Let's do a little lightning round. Ready? All right. Best deal you ever did?
Oh, that's a good one. I would have to say we did a wholesale deal in North Carolina. It was two larger facilities. We locked them both up for roughly, I think we had $80,000 at risk. And then at the end of when we assigned our purchase contract to the new buyer, we walked away with a $2 million check. So that was probably the best deal I've ever done. And that was, I think it was 6 months to turn 80 grand into 2 million.
And that was just flipping paper.
I was flipping paper. That was it. Yeah.
That's awesome. Worst deal. And what did it teach you?
Yeah, man, I got a ton of these. So not in self-storage, but in other asset classes. So I remember the very first apartment building I bought when I was 23 or 24. I can't remember now, but it was the first one I bought. I bought it without seeing it. I bought it using credit cards, a cash advancing from credit cards. And it was in an area that had declining population and was very rural and had basically no one there. So that was a very tough deal. Did not get the returns that I was looking for. It came with a bunch of issues when it came to, the structure, the foundation. It was very old product. So I learned a lot of things. Number one, either you got to put your eyes on the deal, or you got to hire people that are trustworthy enough, and you hire them specifically to go put eyes on the deal. So for example, for us, we'll hire an engineer to do a property condition assessment. So they'll walk through the entire property. They'll tell us all of the repairs that needs to be done now and the schedule of repairs that need to be done over the next 10 years and how to save money for those repairs, including what type of return you get on that money if you put it into a saving account, et cetera, so that it grows to the amount that is needed when that item needs to be replaced. The roof, HVAC, whatever. Number two, do not buy in areas that are losing population. That is a huge no-no. So especially areas that don't have a lot of diverse jobs, maybe it's like a factory town, and if the factory shuts down, you're out of luck, right? Don't buy old product. That's an easy one. The older the asset that you buy, the more deferred maintenance and problems that you'll find along the route. And then if it's very old, the amount of hands that has changed ownership, a lot of people doing duct tape and band-aids trying to pass it on to the next person's musical chairs is just not worth it. So we don't buy old product anymore. We prefer to build brand new because then I know the standards that we're building to. And then due diligence, not only making sure that you have your own due diligence, but you have somebody checking your due diligence to make sure you're not wearing rosy colored glasses. Because all of a sudden, red flags look like pink flags, and then pink flags start looking like white flags, and then you think you got an all right deal, and then turns out that's not the case. So you got to accept that there always are biases, no matter what. The key is that you can't really eliminate your biases, but at least you can find a way to protect against them. And by bringing a third party that is not financially involved in the performance of the asset, they get paid up front. So the result of their report, isn't skewed. That helps a lot. I mean, if we got another 2 hours, I can keep going on, but I'll leave it at that for right now. A lot of, and then the biggest one for me is don't let anyone live inside of your investment. That is a huge no-no for me. So no more apartments, no more houses, no more mobile homes, none of that. No more Airbnbs. No one is allowed to live in my investments because the number one risk you can have.
No multifamily, huh? Done with that.
No, done.
One belief that you have about investing that most people disagree with.
Yeah, man, there's a lot. One of the camps that I always fight with is, the cash flow camp, the people that they want to buy an asset and hold it forever. I'm not saying that's wrong. I'm just saying it depends on the time of your life, right? Because what I do is I force a lot of equity by buying things below what they're worth, getting them to a stabilized value. And then once they're stabilized, instead of just holding it forever, what ends up happening, you have diminishing returns. It's kind of like the Laffer curve, if you will, when it comes to taxes. So what it's better to do is, let's say over a 30-year period, if every time you hit peak equity, which could be, let's say, every 3.3 years, and then you sell, even if you're taking a tax hit, you can then reinvest that and do it again and do it again. And so in a decade, you may be able to double your money twice or 3 times. And over 3 decades, it could be the difference of your net worth, being $1 million over 30 years or $30 million over 30 years. Because every time you hit peak equity, you sell, you capture that equity, and then you go buy something else that is below as is value, and then you push that equity and do it again. So that's one of the biggest things that I fight with other camps. And I'm not saying that's wrong. I'm just saying in my point of life, it doesn't make sense. Now, let's say once I'm closer to being retired, and I don't want to have to do the day-to-day stuff, then I'll build a couple self-storage facilities from the ground with no debt and no investors, just my own cash, and I'll just let them ride for cash flow, and that'll be good enough. But that's not what I'm doing right now. Right now, I'm trying to, 10x my net worth.
Are you exiting every 3 to 5 years?
Yes. Typically every 3 to 5 years, we'll sell off a large portfolio. The last large portfolio we sold was in 2022. This summer/fall, we're going to be selling another 9 to 11 assets. So yeah, it's roughly every 3 to 5 years where we're selling almost everything.
Amazing. What are you focused on right now?
Yeah, I am very excited. We're kind of going into an offshoot of our main business, and that is contractor storage. So during the pandemic, because online shopping became so large, you had people like Amazon, UPS, DHL, FedEx buying all of these small bay industrial, 2,000 to 6,000 square foot spaces to turn into last mile shipping, so that when Fernando wanted to, buy some gum on Amazon Prime or Amazon.com, it would show up to my house same day, as opposed to in 3 days or a week, right? And so that's how they do that, is by opening up all these little tiny last mile shipping hubs. But then what this ended up doing was displacing a lot of contractors that were using those spaces, small, self-employed, like HVAC, plumbing, electrical, these types of guys. So now what we're seeing is there's this huge demand for these units that are in the, 1,200 to 2,000 square foot range. And you can treat them just like self-storage, which is a benefit to them because then they don't have to sign 10-year contracts, which is typical of like industrial. And it allows us to raise rents when there's periods of high inflation, versus if there's a period of high inflation, you're trapped in these preset contracts that only allows you to raise the rent, 1% or 2% a year. You don't get caught in that. So these guys, we found out that if we build these 30 by 50 units, so it's like a very large self-storage facility unit with a larger overhead door that you can, bring in a truck. They can create a little workshop in there, they stay forever. Those guys will basically stay until either their business fails or their business does so well that they can buy or build their own warehouse. So that is what I'm super excited about right now, is we call them pro units or contractor units. That's the next space. It's kind of a gateway drug into small bay industrial for self-storage operators.
Nice. So light industrial.
Yeah, I always say it's kind of like light industrial, but it's more like self-storage, because typically light industrial, you have to sign these kind of 10-year or 5-year contracts, because people are going to put, pretty substantial machinery into these locations. So I would call it like very, very small bay industrial or hyper small industrial, because we're really only using units that are like 1,250 square feet up to like 2,500. That's the max. So the sweet spot for us is like a 30-foot wide by 50-foot deep unit that has enough roof height that if somebody wants to build a mezzanine level in there to have like a little office space above, their workshop, they can do that. And we have found a bunch of success with this.
Amazing. What's the biggest opportunity in the next 12 to 24 months?
I think this is one of those opportunities. Not only that, but then also just continuing to invest in self-storage. Self-storage used to be an event-based need: death, divorce, downsizing, moving to a new town. And it was a short term, it could end at 3 month to 6 month, whatever. But what we're seeing is, with the affordability crisis getting worse and worse in the United States due to restrictive zoning and kind of the NIMBY movement, not in my backyard movement, what people are starting to do is now they're opting for smaller residences because it's cheaper, and then using self-storage as a permanent external closet. And we only see that going up. Prior to the pandemic, 1 in 11, 1 in 12 people use self-storage. These contractor units or these pro units are a huge opportunity. We're starting to see more and more need for that. And then also kind of with this AI side of things, it's very hard for AI to replace a plumber or HVAC guy or an electrician. So I think these are going to be continuing to stay pretty strong through this disruption. And then in addition to that, just, regular self-storage. What we're starting to see is this move away from an event-based rental, someone downsizing, death, divorce, moving to a new city, where they're only using it temporarily, to more of a permanent use of self-storage, where now people are, because of the affordability crisis in the United States, they're opting for smaller and smaller residences and then using self-storage almost like a permanent external closet.
Fernando, for anyone listening who wants to learn more, invest, connect, where's the best place to find you online?
Yeah. If you're a passive outreach type of person, reach us on our website, SSSE.com. That's SamEdward.com. And if you're more of kind of like a active outreach person, this is my real cell phone. Give me a call. It's area code 630-408 8090.
Love it. Love it. What does SSSE stand for?
Yeah, it's self-storage syndicated equities. So we kind of went the way of IBM. We went from international business machines to IBM, and we're doing the same thing with our website. It was just having an email address that was Fernando@selfstoragesyndicatedequities.com was a little too much. So it's a lot easier to type in Fernando@SSSE.com.
I love it. Fernando, this was powerful. I think what stands out the most is the level of discipline behind everything that you're doing, not just chasing returns, but structuring deals in a way that actually protects capital first. And for a lot of people listening, this shift alone, thinking about downside before upside, is going to change how they approach investing entirely. I appreciate you coming on and breaking down the way that you did business. To everyone listening, if you got value from this, share this with another operator who's actually building or investing at a high level. Subscribe if you want more conversations like this. Real operators, real strategies, real insight. And as always, we'll see you on the next episode of the AI Edge podcast. Thank you, Fernando. I appreciate you being there.
Yeah, thanks for having me.